Good morning and welcome to the SERINUS Energy PLC H1 results investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Jeffrey Ord, CEO. Good morning, sir.
Good morning. Good morning, everyone. Thank you for joining us for the financial results for the 6 months ended the 30th of June 2024. My name is Jeffrey Ord. I'm the CEO of the company. I'm joined today by Vlad Rybov, our CFO, Stuart Morrison, our COO, and Calvin Brackman, our Vice President of External Relations and Strategy. As a quick update for everyone, we have two asset areas. We have Romania and Tunisia. Romania is a large concession. We have found, developed, and produced the Moftino field, and the Moftino field generated just under $100 million of revenue for us over the life, and roughly an investment of about $15 million. We believe there are other, we've got at least 32 other prospects that look similar to Moftino. And so it's a place where we think we can develop these small shallow gas fields at quite profitable rates. Tunisia, we have two areas in Tunisia, Siberia and Shweshasida. Shweshasida is way down in the south, right on the desert, and Siberia is a large 445 million barrel in place oil field in the center of the country. Both of those fields could do with modern production techniques and enhancement, and we've shown in the Shweshasida field that pumps in these wells can increase our production, and they do very well. So we have multiple investment opportunities. We produce oil, we sell it. That gives us our operating cash flow to go off and do other investments in our fields. We are debt-free, and our capital investments for 2024 are funded solely by internally generated cash flow. Remarkably, the company is valued at 47 US cents per BOE equivalent of reserves. These are third-party audited reserves, a sector average of just over $8. So these are very, very cheap reserves in terms of equity valuation. I've talked very briefly. These are little maps about where our assets are, and you can see that reserves exist largely in Tunisia. Romania, the Moftino field is coming to the end of its life, and so we've had some good production there, but that well and truly is tailing off towards the end of its life. Highlights for the 6 months: we were granted an extension to the Satu Mare concession. The extension carves out the commercial area of Moftino field, and the extension gives us 2 more years of work, and that work is largely exploration work to find the next Moftino. In Moftino, there's additional gas zones. We've identified those gas zones when we were originally developing the field, and those gas zones weren't produced at the time because there were more prolific zones in the wells. So the completions in the wells were targeted towards the most prolific zones. Now that those zones are largely depleted, we can go back to these other zones and produce those. So there's still considerable gas there. The question is when we go about and develop it. And we've talked about the Kanar-1 injection well. This was one of the wells we drilled hoping to find gas. We didn't find gas, or we didn't find commercial quantities of gas. We did find gas, but not commercial quantities. And so we've changed it. We've converted that into a water disposal well. We now dispose of all of our produced water through that well. That gives us about a $600,000 a year annual savings. So ironically, we pay back the well using it as a water disposal well. Financial highlights. Vlad, I'll hand it over to you, and you can take it from here.
Thank you, Jeffrey. Thank you, Jeffrey. I'm pleased to present a summary of the company's financial performance for the 6 month period ended 30th of June 2024. For the first half of the 2024, the company reported revenue of 8.8 million from the production of 110,434 barrels of oil equivalent. That is slightly down from 8.9 million in the first half of 2023. Despite this marginal decrease in revenue, our gross profit saw a significant improvement, reaching 1.7 million compared to 800,000 in the first half of the 2023. EBITDA rose to 1.6 million, up from 500,000 in the comparative period of the previous year, predominantly due to introduced cost controls and reduction of G&A costs at a corporate level. Funds generated from operations were 1.3 million. That is a significant improvement from 400,000 used in operations in the first half of 2023. Our general and admin expenses decreased to 1.8 million, or $16.66 per barrel of oil equivalent. That is down from 2.7 million, or $22.54 per barrel of oil equivalent in the first half of 2023. The net loss narrowed to 1.3 million compared to 3.2 million loss in the first half of 2023. Capital expenditures were $300,000, that is all in Tunisia, and is down from 3.1 million in the prior year, with no capital investments in Romania. For the first half of 2024, the company achieved a net realized price of $8.13 per barrel of oil equivalent. That is up from $74.93 per barrel of oil equivalent in the first half of 2023. This included a realized price of oil of $84.07 per barrel of oil equivalent, and a realized natural gas price of $11.06 per MCF. The overall operating netback increased to $32.43 per barrel of oil equivalent, compared to $31.18 per barrel of oil equivalent in the first half of 2023. By region, Romania had a negative operating netback, and Tunisian operating netback was offsetting that, bringing up the overall improvement to the overall company netback. The cash balances of 30th of June 2024 was 1 million, and remains under very tight control, and we think is quite healthy given the circumstances. In the first half of 2023, the company, as I said before, the company generated 8.8 million in revenue. That is slightly down from 8.9 million in the same period of last year, and predominantly due to lower production in Romania, but supported by the increased production in Tunisia and much better commodity prices in the first half of 2024. Cost of sales decreased to 7.1 million from 8.1 million in the first half of 2023. While production expenses and royalties remained flat, the decrease in the production cost is driven by lower windfall taxes and lower depreciation. As a result, gross profit increased to 1.7 million from 0.8 million in the comparative period of 2023. The resulting net loss for the period was reduced to 1.3 million, an improvement from 3.2 million net loss in the first half of the previous year. In the first half of 2024, the company produced an average of 607 barrels of oil equivalent per day, totaling 110,474 barrels of oil equivalent for the whole period. Production in Romania was 48 barrels of oil equivalent per day. That is driven by the decrease and the natural decline of the Martina gas field. The Romanian production remained stable, although during the first half of 2024 it was derived from one well, while two other wells are waiting completion. In Tunisia, production increased by about 5% compared to the first half of 2023. That is a result of continuous reservoir management, reaching the overall Tunisian production reached 559 barrels of oil equivalent per day. The company's average realized price was $80.13 per barrel of oil equivalent. That's again driven by higher oil prices despite lower gas prices in Romania. Specifically, Romania's average gas price was $9.43 per MCF, and Tunisian average crude oil price was $84.07 per barrel. In the first half of the 2024, our total production expenses remained really steady and were at a level of 4.2 million. That's pretty much the same what we had in the comparative period of the previous year, with Tunisia accounting for 3.2 million and Romania accounting for about 1 million of the overall production expenses. The unit production expense averaged $37.83 per barrel of oil equivalent for the first half of 2024. And reflecting on the netback, which I touched on before, the company's operating netback was $34.43 per barrel of oil equivalent. That's impacted by the lower gas prices and production volumes in Romania, but offset by the higher oil prices and increased production volumes in Tunisia. In the first half of the 2024, the company's capital expenditure comprised $300,000, all of which was spent in Tunisia. The company generated 1.3 million of funds in operations from operations, with Tunisia contributing 3.7 million, Romania using funds in operation of about $700,000, and corporate expenses accounting for 1.6 million. The EBITDA increased to 1.6 million, up from $500,000 in the first half of the 2023. That is predominantly due to controls implemented in Romania and Tunisia, trying to keep all of the costs under control, and as well as introducing efficiencies at the corporate level, bringing corporate G&A expenses to 1.8 million compared to 2.7 million in the first half of 2023. I'll hand it over to you, Stuart.
Thanks, Vlad. Regarding safety and environment, we've had another good period on the safety front. We continue to have no lost time incidents, which we're very, very pleased with. Now, as we gear up for further operations, we're also making sure that training is up to speed, that everybody is going to have the correct level of competency and will be able to perform the job safely and well. On Moftino, well, it's a pretty new plant, so the fugitive emissions are pretty minimal. We're also trying to reduce the amount of electricity we take from the grid, for example, through solar panels. We have done for a number of years had strict monitoring of the company's Tunisian facilities, both Sabria and Shwesha Saida, and we hold ourselves to higher standards than the local regulation. We also have environmental inspections at both properties, and those gas emissions have been audited for a number of years. So back to you, Jeffrey.
Thanks, Stuart. Well, just to conclude, we continue to generate stable cash flow. Production, as Vlad said, production's up about 5% in Tunisia so far this year. We would like to get those workovers. We have 2 inconclusive workovers. We would very much like to advance both of those. Both of those go deep into the field in the oil zones. Those are both good potential producers, and we very much like to advance those. The asset base gives us opportunity to allocate capital. A few years ago, we were allocating capital into Romania. We took $100 million of revenue out of that. Now we're allocating capital into Tunisia, and we hope to increase the production of those fields. A 5% increase in production from those fields is about $800,000, $700,000 a year. So little increases can have a real meaningful effect. The capital plans this year, N2 has been, we did the workover. The workover went well. We are still working with our partner who is reluctant to do acid stimulation. We're not entirely sure why. It may be capital, it may be technical understanding. The W1 sidetrack, as of last week, all of the long lead items are now in country. So the completion fluid was the last to arrive. The CTF-04 rig, which is the rig we hope to use, is currently in the shop getting recertified and having its routine maintenance done. It then goes off to 2 operators who are in the queue ahead of us. We've said we would hope to get that done at the end of this year. Depending on the workovers of the other 2 operators and the timeline of that, it's maybe the end of this year, could slip into the start of next year. But that all of the long lead items are in country, so we're pretty much ready to go, waiting on the rig availability. Wind 12 artificial lift, we've said that our partner has requested that we demonstrate a pump in one of the other wells before we put a pump into the Wind 12, which is our best producer. So we're hoping to do that as soon as we can get that W1 sidetrack and get a pump in that well. Romania, we've done our block-wide geophysical study, a geological and geophysical study. We're devising a 2D seismic program to try to find the best next exploration opportunity to try to replicate the Moftino gas plant. There's lots of long-term exploration on the Moftino block, and in fact, there's exploration down in the Schwechat field. And over time, as we accrue capital, we would like to be able to go and grow by exploration rather than just grow by working those fields better reservoir management. And that's a bit of the summary, and I'll hand it back to Paul.
Jeffrey, thank you very much indeed, and thank you to the team for the presentation. Ladies and gentlemen, do please continue to submit your questions just using that Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions both throughout today's presentation and both pre-submitted. So Jeffrey, if I may just hand back to you just to start at the top, read out the questions where appropriate to do so, and I'll pick up from you at the end.
Sure. First question, how does the company plan to raise money for the projects mentioned? I think we have commented that our capital plans are matched to our operating cash flow. So we produce oil, we sell oil, we take that revenue and we reinvest it in our capital plans. There are currently no plans to raise money. I was once told never to say never, but there are no plans to raise money. Our capital plans are matched by our revenue. It would be great if we had $100 oil and we could move faster. And I think one of the great frustrations is we can't move as fast as we'd like to move because we have to accumulate the cash to be able to do the investments. But we have no plans to raise any money. Currently no plans to raise any money. Next question, considering many years of losing money on failed drilling, what measures are you taking to reduce cost? Well, we had 2 exploration wells that did what most exploration wells do. In our case, Canar 1 and Moftino Nord both found gas, but not in commercial quantities. So yes, they were failures. The 2 workovers in Tunisia are not concluded. The N2 well, we are still trying to convince our partner to acidize that well. We believe we should have acidized it right at the start. That's what you do. But our partner, for whatever reason, is reluctant. They are a 55% owner. So there's a convincing program going on. It's taken a long time, but that well is dewatering at a very, very slow rate. But that workover is inconclusive right now. And then we have the W1, where we ran into junk in the well, and we're well on our way to sidetracking that. So yeah, these are not screaming successes, unfortunately. But the 2 in Tunisia, I don't think we can call them failed yet. What measures are we taking to reduce costs? Well, I think Vlad went through, the first half of 2023, G&A was 2.7, and the first half of 2024, it's 1.8. So we're actively trying to squeeze costs out of the business. We would very much like to invest in the business. So costs that aren't going directly towards operations, we are very actively managing those. Investors voted for a share buyback program. When will the process start? Well, that's not entirely correct. Investors authorized the company to buy back up to 10% of its shares. That's a standard authorization. There is no plan for a share buyback program. Capital right now is being accrued to invest in the business to grow. So capital is not available to buy back shares. And that's not what the intention of the resolution at the AGM was for. That was a standard resolution to allow, under circumstances that management deems to be appropriate, for the company to buy back up to 10% of its shares. Next question, is there just any justification for incurring operational or overhead costs in Romania? Yeah, this is a difficult one. Romania is currently running at a loss. And we do that because we have zones of gas that we would like to complete. We also do that because to shut in that field requires the shutting in of the gas plant, which is quite expensive. And once you've shut it in, it's quite expensive to turn it back on again. So you have to be very, very sure. And given that we have those zones of gas that we'd like to produce, it's a question of, we're going to run through a situation in Romania where we're not profitable to get to a point where we are profitable. But to shut in now, we would abandon all of that the gas in the alternative zones or other zones. Should consideration be given for shareholders to vote for Romanian assets to be sold to fund special dividends and share buybacks? Shareholders can always propose special resolutions, but I think that would be a move that would be taking a lot of the company's future away from it. There's great exploration opportunities. We've shown you can make money in Romania. We've shown these developments are efficient, and we believe there are other Moftino-like structures out there. So, let's not forget the $100 million of revenue and the $40 million of after-tax cash flow that field generated on a $15 million investment. Those are good investments. What, in management's opinion, is the reason why Polish investors are feeling discriminated against and ignored? Well, we have the same contact page for all investors. So if Polish investors are feeling ignored, they should reach out and contact us. Discriminated against, we have 6.8% of our shareholders in Poland. The shares there trade at about 10 times what they trade in London. This is not an arbitrage opportunity, simply because there are only just over 7 million shares that are eligible for the Polish depository. So a very limited number of our shares can actually trade in Poland. But we would be eager to talk to Polish investors if they're feeling discriminated against or ignored. Please reach out to us. We'll make sure that situation gets remedied. Why was the acidization procedure not included in the well Sibria N2? Were you aware that such a procedure might be necessary? The acidization was included in the AFE for the well. We always thought it may be needed. This is not a question of being surprised at the outcome. This is a question of being surprised by our partners' reluctance to proceed with acidizing that well. We would very much like to get into that well. We had planned it. We had done some work on acid composition. We thought that it would be a possibility. It's always a possibility. And we had actually proposed to our partner prior to drilling the well that this would be a possibility. Upon getting to the situation where the well didn't flow, didn't dewater as quickly as possible, or as we like, our partner then decided they didn't want to proceed. And unfortunately, in Tunisia, there's no sole risk. So we can't, under a lot of contracts, you can go out and you can, pay for it yourself. And if it's successful, your partner backs in at a multiple of what you paid. And if it's unsuccessful, you bear the cost. There's no sole risk ability in Tunisia. So we are a little bit hamstrung. But yeah, we did anticipate that, and we did believe that that was a possibility. Warren Buffett, since the age of 6, used an arbitrage strategy related to the market efficiency theory. With the unprecedented arbitrage opportunity and equivalent SERINUS asset price 3,000% higher in Warsaw and London, why is management refusing to engage with shareholders to explore this opportunity? Well, firstly, management has never refused to engage with shareholders to explore an opportunity. That's just not true. Anyone who wants to engage with us, or anyone who wants to understand why Poland trades differently, we're happy to talk to them. I think it was the 5th of February 2021, we put out a fulsome press release explaining that Warsaw was acting as a false market. We warned shareholders that this was not a reliable market. Trading, these are the same shares, the same ISIN numbers. So trading in Warsaw at 10 times the price makes no sense at all. We've taken legal advice. We've talked to the stock exchange. We've done all sorts of things to try to remedy this. And the simple answer is we're restricted shares to 6.8% in the Polish depository, and those shares traded effectively off on their own. But it really is not true that we haven't engaged, and I don't know when. I don't know when the last time I've had a shareholder approach me on the Polish situation, but most certainly it hasn't been in the last year. So anyone that says we're not engaging hasn't contacted us. Have we got any thoughts regarding capital allocations going forward? Are we going to look at further development in Romania first, or Tunisia as a priority going forward? Second, any thoughts regarding the capacity for share buyback? Does the liquidity exist for this at the moment? Yeah, I think I talked about the share buyback. Ultimately, we're focused on Tunisia right now, getting those pumps in. We think that that's the nearest term return on capital that we can generate. Clearly, we've got exploration in Romania out there, but that's definitely taking a back seat to work in Tunisia right now. We have producing oil field where we can put pumps in the wells and get going. So that's clearly our focus, and that focus means that no, we don't have excess capacity to go buy back shares. Do we have a firm plan to recomplete the 2 Romanian gas wells, or is this contingent on changes to the windfall tax and higher gas prices? Yeah, I mean, we do have firm plans. We have these wells are both costed out and budgeted. So what we're referring to is the opening up of the uncompleted zones. So yeah, we have full plans for that. But you have highlighted the two issues. Firstly, the gas price in Romania is not what we were selling for certainly last year. So gas prices aren't great. So sort of sitting idle waiting for better gas prices is one of the visions. And the second one is, yeah, that's a very, very punitive windfall tax. There are elections in Romania, I think it's in September. We're hoping that there would be changes, a more business-friendly, a more growth-friendly environment. So yes, one of the things we do are waiting for environmental changes. The business environment we're hoping can progress, but we certainly have fulsome plans. We'd love to get on those. The gas is there, and we'd love to get going. What would be the realistic value of assets in Romania if you shut down or sold the Romanian operations? Is $24 million a realistic, realizable value? I don't know. I don't know what the value is. It's sort of, you don't know until you try to sell it. I know that others in the country have tried to sell equipment. Activity in Romania is pretty low right now. So I wouldn't think it'd be a great time to sell. Is it a realistic, realizable value? Again, I don't know. You only know when you try to get out there and market and try to sell it. You speak of $100 million of revenue out of Romania, but what profitability has Romania generated over its lifetime to date? Well, it's $100 million of revenue and just over $40 million of after-tax cash flow. So that's pretty good measure of your profitability. That's on about, I think it's just under $16 million of investment. Can you outline what needs to happen before you can collect the $2.5 million of Romanian VAT refund you were awarded in arbitration? Oh, if I could answer that. We won a court case. So this goes back to when we had a defaulted partner. For a couple of periods, the Romanian tax authorities withheld 40% of the VAT rebates. And they did that on the basis that that was the 40% of the disputed or the defaulted partner. Once we had the ICC arbitration award against the defaulted partner, that there's no reason why that shouldn't, we were awarded, the partner was defaulted, we were awarded 100% of the asset, and that should have been reverted to us. And the tax authorities took a very, very long time. We took them to court in Romania, and in December 2023, we won a court case that again awarded us our money back. Remember, we paid this money. We can show it came out of our bank account. We paid as operator. We paid it, and it's simply not being refunded to us. In April, I think it was April, ANAF, which is the Romanian tax authority, appealed the December judgment. They are granted a statutory right to an appeal. They have not provided any legal arguments for that appeal. It very much it appears just to be a delaying strategy. So what needs to happen now? We're waiting on a court date for that appeal. Once we get that appeal, we'll go to court again. I can't see any reason why we would lose, and penalties and interest are accruing to the Romanian state. But it's a very, very frustrating situation. It's an impact on our cash flow. It's $2.5 million, which is meaningful for us. That would be, that would be those 2 recompleted wells in Moftino. But until that's resolved, it's pretty, it's a tough cash flow situation. And I guess, I think that's all. Here's one. The 2003 annual report shows $52 million of assets in Tunisia and $24 million in Romania. What are the corresponding liabilities? I'm gonna put Vlad on the spot here. Vlad, do you have the corresponding liabilities for Romania and Tunisia to hand? We've got $52 million of assets in Tunisia and $24 million in.
Jump out and get our 2023 annual report, because I think we disclosed all of the assets and liabilities on the segment basis in the 2023 accounts.
Yeah, sorry, I don't have my 2023 accounts to hand because this is first half 2024. Okay, well, let me just.
They disclosed in the 2023 financial statements in the segment note.
Okay, note number 2.
Yeah.
Okay, good. And that is the end of the questions. So, Paul, I'll hand it back to you.
Fantastic. Look, thanks for answering those questions you can from investors. Of course, all questions submitted, the company can review those and we'll publish responses on the Investor Meet Company platform. Before redirecting investors to provide you with the feedback, which I know is particularly important, Jeffrey, if I may just ask you for a few closing comments.
Good. Well, firstly, I want to apologize that I didn't have my 2023 accounts to hand to answer that question, but Vlad's been clear. It's in note to the corresponding liabilities, and apologies we couldn't answer that on the call. But thank you for everyone for attending. We continue to produce, generate revenue, generate cash flow. Looking forward to getting that rig and getting the W1 sidetrack going. And as Stuart said, we've been operationally inactive for a little bit. So the focus right now is making sure everyone's training, everyone's ready to go when we get our hands on that rig and we can go. And we're hoping that the operators ahead of us are quick, they don't have any problems, and we can get on with it as quickly as possible. The very, very good news is, the completion fluid, all the long lead items are now in country, and we're ready to go with the equipment. So including having paid for the bulk of that. So it's rig time, rig rates, and getting on with drilling that's coming up for us. And we just want to get on with that. And thank you again for joining us for these results.
Fantastic. Thank you indeed for updating investors today. Could I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and remains greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, I'd like to thank you for attending today's presentation. That concludes today's session. Good morning to you all.